trying to get the fundamentals, the metrics and stuff like this, and just to give, kind of a recap to do the fundamentals. It's nothing too deep or too in-depth, nothing like that. And Ty will probably be on over the technicals with the charts and stuff afterwards.
Yeah. All right. So real quick, let's do this again. Disclaimer. Tonight's Saturday session is for educational purposes only and merely ideas given by me and Sean. Nothing stated during this Zoom session should be taken as an indication to buy or sell. Nothing stated in the Zoom session should be seen as investment advice. If investment advice is needed, I ask that you please contact a registered financial advisor or fiduciary. Financial advisor, financial advice. Let's see, admit, stop this, share. And it's all you, Sean.
Can you guys see the screen?
Yes.
Yes.
All right, yeah. So when you looking up the companies, you want to take in consideration of the 10Ks, 10Qs, and looking up the CEO. Most of the time, you can either go to the investor relations page on the actual company website, or you can go dig into the SEC.gov site. Me personally, I kind of like to do both. So the two companies we was looking up, we decided on was Best Buy from the suggestions in the other chat, Best Buy and DocuSign. So I just pull up the Best Buy Investors Relations page right here. You want to look at the executives and the board. Check out the CEO, president, and all the executive team members. Right here, after you find that, you kind of do a little Google search, or look on Forbes and try to see what information you could find out for the executive, and see what type of leadership they have as a team, as a whole, and also see who's actually putting in plan the direction for the company, see where they're going. You also could pull up the 10Qs and financial information for the quarterly earnings and SEC filings off of this page.
Real quick, Sean.
Uh-huh.
So I know why, but why is it important to look up executive board members, CEOs, and all that other stuff?
You kind of want to see their history and see what kind of forward thinking, innovative things that they have, and some certain areas that they might be looking to develop as far as in the company. And you also want to check to see if there's any scandals or any types of things in their background that might come up as a red flag. And also you want to check to see what their involvement with the company is, as far as they're investing, and whether they're selling shares or holding on to shares, buying shares, things of that nature. Anything you want to add?
Nah, I put in the chat somebody that's pretty much you would want to stay away from, like people like that. So I said Trevor from Nikola. If you would have did your research on him prior to, you would have seen that he actually never completed anything that he started, or he just kept going from business to business to try to make something shake. So you just got to know who you actually get in bed with before you do.
Yeah. And most of the quarterly reports and different types of filings that they do with the SEC will be listed in here. The 8Ks usually tell you just announcements and other things that they reported to the company, different changes of ownership, sales of or reissuing of bonds, stocks, or buybacks and things of that nature be throughout the 8Ks. But you go to the SEC.gov site and the company filings, you could just put in the symbol.
That could be a Google search. How do you find out how many shares they have in the company? Google search. And then while you're doing your research, I'm sure he might also touch on that.
Ten Q right there. Let me find the 10K document also right here. You just pull these up. Let me know if y'all need me to go slower or go through anything else. And through here on the 10K or the 10Q, whichever one you're looking at. But for most part, the 10K is going to be the annual, and 10Q is going to be the quarterly. And the 10K gives you a bigger overall picture of the company. So I usually look at that depending on what, I'm trying to determine, what factors I'm trying to determine. And you just go through here. But most of the stuff that I look at is generally the risk factors in here. And the financials. I'll go to the sections right here and just so I don't have to go through all of this stuff. And I'll click on the financial statements, the consolidated balance sheet, just to go straight to it. And you'll find all of the information through here. And also, if you do Yahoo Finance, is another source that I'll use a lot. And pull up the company's financials information just to kind of gauge back and forth to see what's accurate and compare the information up there. You have the income statement, balance sheet, cash flow. You could search it annually or quarterly on there as well. Put on there quarterly. Let me go back to the okay. Now, after you've done your research on the CEOs, you could determine whether it's a CEO you could, potentially be in bed with and get behind. That's gonna, move the company forward. You want to try to find out from the balance sheets. The working capital is one of the first metrics that you want to look for. It's the total current assets minus the total current liabilities, and you'll find that on the balance sheet over here. Where do you just go? The total current asset, total current liabilities right here, and total current assets. Where did that go?
Right above property and equipment.
Yeah, there we go. I'm bugging now. And total current assets are right there. And this is usually in the millions, sometimes depending on the sheets, they have in the thousands and some other sheets as well. So you just minus the total current assets and total current liabilities, and you'll get your number. Most of the times most of the times you want something that's always positive. You don't want to look at something that's negative in that number. You always want to be positive for that number for the working capital. And you can also find that information off of the balance sheet over here and Yahoo Finance as well on the side over here. Expand all.
Yes, it will.
Over there on that side over there. And then after the working capital, you gauge what their what that number is and make sure it's positive. And you go to earnings per share, will probably be the next metric you want to look at, and you can get that from the income statement as well, and that's going to be the net income or the net profit divided by all shares outstanding. Go back to the. And you want to get that from the income statement as well. And they give you the revenue and information. Let me come on to this here. Here we go. And you just take the net income, the all shares outstanding, the net income divided by the all shares outstanding, and you want to have the higher the number, the better. This just means it's more profitable. And a lot of times that number could be given to you on on um on the Yahoo Finance as well, and you'll see what the EPS will be coming up, and you can kind of see some of the earnings numbers over here, and you can look to see if they beat or missed it or whatever over here as well. The next number you would like to look for is the PE ratio, and this is price per share divided by the earnings per share. And that's just pretty much the stock price divided by the earnings per share, which is the EPS again. And most of the time, you'll find the earnings per share as a number for the PE for the trailing 12 months number. Wait a second. And then here they'll give you the EPS is the trailing 12 months TTM, and they'll give you the PE ratio right here. And you can find this on other sites as well. You know, I use FinViz, Macrotrends, Seeking Alpha, and different things of that nature. And some of the companies that don't have any earnings or is losing money, they won't have a PE ratio. And pretty much is the lower the better. And it's pretty much just the price that you're paying for the share of the earnings for that company. And the next metric to probably look at is the debt to equity ratio. And that's usually you can get those numbers. It'll be the total debt divided by the total equity. And that'll be on the balance sheet. Let's go to the balance sheets over here. Hold on 1 second. Yeah, with the total debt, you find that up over here, which would be the total liabilities down over in this area, and you want to find the total equity, which would be the shareholders' equity, and that'll be listed down over in this area as well. And then you just divide those two numbers, the total liability divided by the total shares and equity, and that's what you'll come up with a number. You don't want to look for, you want to look for something that's nothing greater than like 0.5, nothing above 2. 2 usually indicates about like 2/3 of its capital, and they get the capital about 2/3 of the debt, and 1/3 of the capital is from the shares of the shareholder equity.
All right. So after you get your numbers and everything, where do you look to see what the actual company does? Their mission statement,
Oh,
so you
all
can
of that,
actually. know what you're getting into, because you can look at Best Buy's numbers, you can look at their CEOs, but if you don't know what Best Buy actually does, if you don't know what their mode is or what may have you, you might not want to actually get into that company. Numbers look good, charts look good, but if you can't stand behind the company, then there's no point in getting there.
Yeah, can you hear me?
Yeah.
Yeah, a lot of that stuff would be on the business page, and gives you an overview of what the business does, and also on the 10Q, you'll have areas that highlight the business. It gives a description of the business also. Let me go back. You get a description on the risk factors and the strategies and expanding new products, service technologies right down in here as well. If you're on the table of contents, you see the business risk factors right here. Then another area you'll find about the risk and stuff is over here about the quantitative and qualitative disclosures. And they'll give you a little bit more information about the risk and certain things that the company does to mitigate those risks in there.
Okay, so you think Best Buy is a good company to get in just off of a quick research on what their numbers might be? Like if you were to actually look at it right now, just off of fundamentals, what would you say?
Knowing the business itself and knowing the numbers and stuff like that, yeah, I think it would be a good play. But knowing the price point to get in is actually a little bit more better, to get a better grasp of where you should get in at, as far as, okay, this is what I want to do to grow with the company, and understanding the position that they have with the current state of the economy. I would sit there and just use that and just try to get a price point to get into the company.
Okay. Do you happen to have your intrinsic value stuff handy?
Nah, I don't have that right here right now. But
If
you
I
put that
show a
you
chart,
put
would you be
that
able to grab
inside
it?
you have that inside the YouTube joint, or nah?
I have the video, yeah,
Oh,
but not the actual spreadsheet.
Yeah, I have to go find the spreadsheet.
All right. Stop sharing. I'm gonna show a chart real quick on Best Buy. If you can grab that while I show the chart, and then once I finish that, we'll go back and just look at a intrinsic value of Best Buy.
All
right, so I'm gonna go ahead and share my screen and show a quick chart. Can y'all see this? Cool. All right, so what I do when I'm looking at the charts for a certain company, I like to go ahead and go to the max view. So if I was if you have Thinkorswim, you'll just come over here to your different time frames. You got to go to 3 years first, and then from 3 years, you can change it all the way down to max available. And then from here, I just pretty much give a quick eye look of it and see where it's been, see how far back it goes. So 02 to now, see if it's just been a straight shot up. And you see from 02, it started going up and it came down, and it went down in 13. And then from 13, it went up, and it's pretty much just been, a steady ride. So looking at this, I would say I like Best Buy, looking at the chart, right? However, looking at this also, I'm saying I don't like Best Buy at the price that it's currently at. Why? Because it's kind of high for me. So from there, I'd go to a 3-year chart. And on the 3-year chart, I'm still looking at it and it's still high. And then you can also come on here and you can start looking at the earnings that they had. And you can see if they beat earnings, miss earnings, all in just, this one little area. So you don't have to actually try and Google search it. So you can see back in 2017, they missed. And then 2018, they hit earnings and so on and so forth. What was this? They hit it. And then right here, 2018 is a dip. So what I would do on this, so 2018 to, what was that? August of 18 all the way to December of 18. I would try to figure out exactly why it did that, why it fell. Because it's certain things that you want to know about the business. So in order for you to know and understand everything about the business, you need to know why it's falling. This is a dang near August, September, October, November, December, a 4-month drop. Like, why did Best Buy drop from 83 to 47? We need to figure that out. And then it just went on another run. And then right here in February of 20, why did it drop to 50? We know why, but in a few years, people might be like, when they're looking at it, trying to figure out what's actually going on with this company. And they need to figure out what actually caused it to drop. Obviously, it was COVID, so it's cool. We know it's not something that happened bad to the company that made it, fall down. So we see it hit 119, came back down, and it was at 113, 112, 113 right now. So from here, we can start moving up, slowly. So now we go to a year to look at it. A year still has it high up on the chart. We go to the 180. And then see where it's at on the 180. It's still up here. But it's right over the 200, well, the 20-day, and it's significantly over the 200-day. And then this is what I actually chart on. So I chart on my 20-day. Y'all don't have to. Y'all can chart on whatever you want to. But if I was to put support and resistance lines on here, it would be on my 20-day chart. So from here, this is where I'm actually starting to take in consideration on where I'm going to have my buy-in, right? So looking at this, the high on this Bollinger Band is 115. The low on this Bollinger Band is around 110. So currently it's close to send some more. It closed at around 112. And the low that day was 111. And then if we look down here at the MACD, it was on a downward spin. And then the RSI was pretty much in the middle. So with that being said, I'd probably look at this chart and then go back to the 1 year and see that it's up here. And I'd want it to drop a little bit more down before I was to actually get into this. With it being so high up here, I feel like it'll fall some. And that's just for a long-term position. If it was a option contract that I was trying to get into, then I might wait for a little bit longer, maybe until after the election or something like that, stay away from it. Hopefully it would fall some. And then from there, I'd get in for a long play for an option. But that's pretty much how I break down a real quick rundown on how I break up and break down stocks for long-term and option plays. If y'all have a question on anything with that, let me know. Sean, did you find it?
Yeah, I got it. But you go ahead.
All right, I'm about to stop this share, and you can share the intrinsic value, and then we'll start on DocuSign. And then once you finish the rundown of DocuSign, I'll show a chart for DocuSign, and then you can do the intrinsic value for it. You can go ahead and share your screen. All right, maybe we have technical difficulties with Sean. So I'm gonna go ahead and reshare mine and go over DocuSign. All right, so this is DocuSign right here. Looking at the 3-year and then going to, well, actually, there wouldn't be, hold on, max. Yeah, that's as far back as it go. So looking at this, DocuSign didn't start running until COVID happened. When people actually started realizing that DocuSign was going to be the new wave and the future for everything. So looking at this, I mean, honestly, it looks like a great company, you know. Let's go to a 3-year. Oh shoot. Let's go to the 1-year. Same, still going up. Go to 180. It's doing the same. Obviously, when it ran, it fell down, and that was just because it just ran too hot. And then let's look at the 200. So, I mean the 20-day. So looking at the 20-day, I'm gonna actually open this up a little bit more and go to a 90, just so we can see a little bit more of it. So right now, this is still the high back in September when everything started falling for pretty much all tech stocks, right? And it still hasn't shot back up. It's going back in that direction. How long would it take to get back up there? I do not know. But looking at this, I like it. I'll definitely want to get in DocuSign way before it breaks this line right here. And then with it being under the 20-day and over the 200-day, I feel like you could hope, wait for some slight pullback. But I mean, I think DocuSign is a good company that you're pretty much good wherever you get in on it, especially since it fell all the way down to 180. That would have been probably the best time to get in DocuSign. But just looking at it from this perspective, this is what it's been doing this whole time after it fell. Let's see. It's been staying within this realm. So I would say DocuSign is a good company. I say I like it. I like it around about where it's at or lower. And then if you happen to wait and you wait until 232 and it gets above that, I would say wait and don't get in until you see some type of a pullback. But anywhere around here, I like. Let me see if Sean is still here. He just left. Yeah, probably had some technical difficulties. But so that's how I look at charts. I honestly, and this is just like I said, a quick down and dirty on how to look at charts. It's as simple as looking at the trajectory of it, trying to figure out where it fell, and then go off my Bollinger Bands to see where a good time to get in is. Do y'all have other charts or other stocks that y'all want me to look at while I wait for him to come back? The video. All right. Oh shit. So this is NVIDIA. It's the 1 year. It's 3 year. It's the max. Imagine if you would have got in down here back in 02. Probably wouldn't even be talking to y'all right now. Yes, I would. I ain't say that. All right, so looking at NVIDIA, obviously, it started off down here, and then 2016. So let's go to a 5 year and go from here. Since everything before 2016 is pretty much, just the same. 18, I like it. I like NVIDIA. I do not like it at the price it's at right now, though. 3 year, 1 year. It looks like it's going down. Let's go to 180. Yeah, so I would wait for it to drop a little bit more closer to 5 for me before I was to get in. $20. Yeah. So it's close. So it came close to being oversold on the 20-day. Let's see where it is on the 180. It's nowhere. It's like in the middle. 1 year. Yeah. So, I mean, it still has room to fall. How do I draw support and resistance? I'll do it for one of these.
Can you explain why you don't rely solely on the charting when you're thinking about going ahead and buying, investing in a company?
Because so chart's cool. Chart gives you, you know, the trajectory of a stock. It lets you know if the stock has been going up over the period of time. However, without your fundamentals behind it, you won't know if the company is actually innovative, if the company is going to be bringing out new things. The company could be, you know, on its last leg, and it's just putting out the same stuff that's been keeping it in the game for all this time. So if you don't look at your fundamentals, you'll probably get into, like, let's say NVIDIA was literally not doing anything else to actually move themselves along within the market, you know, of semiconductors or whatever. They could just be stagnant, and you can get in at 522 right here, and then putting all your money in it, saying, okay, I like NVIDIA. It's been running this whole time. Looks like it's going to continue to go. And then without doing your fundamental research, NVIDIA probably only gets to like 530, 540, 550, because they're not really doing anything, you know, to make it work. It's like AT&T. Like, during everything that's been going on with the market, they pretty much been just real still and not doing anything. They stayed within here, you know, 39, 26. It's not going anywhere. If we're out here literally trying to hold stuff for years and years and years, and your stock is only moving $10 throughout the whole time that you're holding it, what are you doing? You might as well just repurpose your money and put it somewhere else. So if you don't do your research, like, look at this chart. You can look at this chart along with your fundamentals, and you'll just see like stock's not really going to go anywhere.
So I wanted you to explain that, because I know when people see charts, it's new to them. They want to, you know, dive right into it. But without doing that fundamental analysis, you really don't know what you're looking at. Let's take Nikola for an example, right? We can look at their charts, but if we didn't do that research on that company, then we gonna think it's the next Tesla, when the fundamentals would have told you, like, no, this is a scam. So, I mean, I know people want to get in the charts, but remember that you have to couple it with, and especially for long-term holds, you want to couple it with that fundamental analysis, because the charts can't tell you everything. And so you want to make sure that you have the other piece of the story.
Exactly. Because if you were looking at Nikola back in June and you didn't even see all this stuff right here, and you just saw, and this is all you saw, you would have been like, well, let me cut this off. And this is all you saw right here, you'd be like, oh yeah, I'm getting it, Nikola. I'm gonna wait for a little pullback, and then I'm gonna hop in. Remove that. And then that little pullback would have shown you right here. You'd be like, oh, this is the perfect time to hop in, Nicola. Perfect. And it's gonna, take back off running. And then this is what would have happened. Just by looking at just charts and not actually trying to figure out the fundamentals behind it. But Home Depot. So looking at Home Depot. Max. Looks good. Let's go to the 1 year. That's what happened during COVID. We already know what that was about. And then 20-day. Let me change this to a 30-day, and then I'll plot some support and resistance lines. I know somebody asked about that. I plotted for this one. So normally, I just look at, yeah, I could do overstock as well. Normally, it's kind of a tough question. I was only doing support and resistance lines for a while. And then I got lazy, I'm not gonna lie. And I started just going off of the Bollinger Bands. Sometimes if I'm actually being smart and want to be a lot more, perfect, well, not perfect, but strict on my entry prices, I'll plot my support and my resistance lines. And I won't jump into a stock for trading unless it actually breaks a line. So this is how I plot mine. So this is a 30-day. I just moved it out some so I can get a little bit more numbers or chart to play with. So I'll go to the high and I'll plot a line for the high. And then I'll go to the low and I'll plot a line for the low. And then from there, I'll look and I'll see where I see the stock going up and then having actual change going down. So a drastic change. So right here, it went up and it stopped and it went down. So this will be one of my lines. And then I'll go through some more. Let me move this up. So right here, I'll put a line. I won't care about that. I'm not going to put a line right here because I'm just going to take it from the low. But I'll put a line right here. I'll put a line over here. And I'll put a line right here. Let me extend this. Let me extend this and extend this. Then take this off. And then from here, I'll start breaking down little sections to make sure that I'm good. So went up, change the direction. So I'll put one there. Just because it stopped right here, I will put a line here. Extend to the left. And I would move this down just because over here it came down to it. Actually, yeah, move it down just a little bit. So for y'all that don't know, your resistance lines are at the top. Resistance lines is pretty much saying a stock rises up to this line and it meets resistance and it falls back down. Your support lines is a line that's on the bottom, and it's saying that a stock fell to the support line, it met support, and it went back up. Always remember, support turns into resistance, and resistance can turn into support anywhere on the chart. So there's a line, there's the top line. That, let me move this down a little bit because I can, boom. And then pull it back, take another little section right here. I'm actually going to move this down. Activate. Just a little bit right there. Looking at it, that's good right here. That's close enough right there. Pull it back out. Take the last section. So that fits right here. Breaks support right here. Goes to it, goes up, breaks resistance. Hits support. Doesn't all the way go through. Meets it, but comes back down. I can put this just right there. So that's how I would do mine. And then from here, I always go to different drawings and just verify. And then remove that. So that drawing that I just picked up was the Fibonacci retracement. And pretty much the Fibonacci retracement shows where different stocks should fall or meet support or resistance, during a specific time frame on the chart. So you can actually use a Fibonacci as your support and resistance, but I like to create my own. But that's how I would do my support and resistance lines.
Question before you move on. So is it better to use like the Bollinger Bands with the Fibonacci if you're new starting out versus drawing your own support resistance until you get comfortable with charting? Or is it better to try to draw your support and resistance and then verify with the Fibonacci?
I always say draw your own. And only because if you don't draw your own, you won't actually start studying the chart to see where it's falling and where it's not falling. Fibonacci is just going to be placing lines where the numbers, seem like it fits, because it's all off of just mathematical equations, and it just goes from a high to a low point or a low to a high point. So I would say draw your own and then verify.
Okay, thank you so much. I'm still new to charting, so that's why I was just trying to get a understanding.
No, it's fine. And then the other stock, let's see, Microsoft. One year, 3 year. Max. Great company. 3 year. Great. 1 year. Obviously, we know what happened here. Ran hot, came back. Hold on. I would wait and see what it does right here. So on the support line, it broke through the support line right here and it closed. Well, actually, it broke through resistance right here. And then it started coming back down to make it support. I would wait and see what it does around 278. See if it stays here or if it tries to drop back down. I wouldn't be mad at this price, but I'd wait and see what it does. Looking at a 1 year. Yeah. Because it's in the middle. Well, going up towards the top. And it's above the 20-day. I would see what it does. I'd see if I can get it back down to the 20-day at least. And then see where it goes from there. If I can get it up here or down here in between this, I'd definitely get in. If it continues to move up towards the top, I'd wait. Remember, don't chase. Microsoft. One year. Fell. 180. Let's see. And then 20-day. I feel like Microsoft is going to do something crazy pretty soon. I actually like Microsoft where it's at. And I think it's a good company. The reason why I said I think it's going to do something crazy is because it's running sideways right now. I think the highest that I've seen it get to was around like 212, 213, and then it gets right back to 200. So with it doing that, me personally, I'm trying to get in around that, and then I think it got to like 180 something or 190 something. Yeah, 198. So anywhere from 198 to like 212, I'm looking at getting it right now, and it's at 206. So I kind of like it. And I actually don't own Microsoft right now. That's crazy. I want it lower, but I might have to bite the bullet and get in. But that could just be me being greedy and trying to get it for a super low price. And I'll probably miss out on it if I do that. AMD. Another good one. So 1 year. For some reason, I think AMD is super expensive right now. That's why I'm staying away from them. But that could just be me. Maybe I'm just being too picky. But good company. I like it. I like that it's below the 20-day. If I wanted it, I'd probably try to get it around the 200-day, but that's just me. What other ones was it? RGN. 3 year, another good one. 180. It's above the 20-day. I'd stick away from it from right now. Looking at that 180. Yeah, I'll try to let this one fall some more. See if it does. And see if I can get in closer to the 200-day. Especially since looking at the 180, it's over the 20-day and the 200. The year, it's over the 20 and way over the 200. So I'd wait for that one to fall some. Apple. Buy Apple whenever you can. I probably can't even talk about Apple because I love Apple. Yes, I do want Apple to fall to $80, but only because I want to buy way more. I mean, I have like 10 plus contracts on Apple. And I know it's going to hurt me if it falls, but I'd rather get more.
Mentioned it needed to close a gap. Can you show that on the chart?
Say that one more time.
Someone just mentioned it needed to close a gap. Can you show that on the chart?
Yeah. It's not going to close this gap. Just so you know. I don't think it will, but I'll tell you what they're talking about. So back in July, 96 to 100, it gapped up. So I'll tell you, so there's two type of gaps, right? there's what is it? I think it's called like a breakthrough gap or something like that, and then there's a gap that gets filled. So if you have, or is it a breakaway gap? I think it might be breakaway. But so one gap just shows that the stock is starting a new trend going up, and not every stock fills the gap. So if it's a stock that's showing a new trend going up, it'll gap up and then it'll keep on going. Me personally, I don't know how to actually figure out if it's a breakaway gap or if it's going to be a gap that gets filled. You'll know if it gets filled if it comes back down and fills the gap. The ones that get filled pretty much would be like right here. If Apple dropped down to 96, but with everything that's going on, the only way that I see Apple really dropping is if when the iPhone comes out, right before it comes out, they say we're not coming out with an iPhone right now because of some reason. Also, if the iPhone does drop and then there's a lot of recalls or something happens, the battery explodes, something crazy, then I can see it falling. But other than that, I highly doubt Apple will fill this gap. It's just been too many times where Apple could have dropped down to fill it and it didn't. And it stayed strong. So yeah, not every gap is meant to be filled. So when you see gaps, don't automatically assume that, I'm just gonna wait for this stock to fill this gap. It might not happen. And if it does happen and it happens like a year, 2 years from now, it's not filling the gap. Somebody tells you, it's filling that gap. No, the stock just dropped because of something that happened. No problem. But yeah, for Apple, honestly, without even looking at a chart, I'm saying get in where you fit in with Apple. And I say that because it's only a matter of time for you to miss out on getting it at this price. And then also, let's say you did buy it right now and let's say Apple did fill a gap, right? You just buy more shares. And then you buy more shares. Who's going to be mad at buying more shares of Apple when 4 years from now it's at $400? You're not even going to care about that. And if you do, you like to save every penny over stock. I believe it's OSTK. So this is one of the ones where, like Kels was saying, looking at fundamentals, right? Because just looking at this chart and looking at the max on this chart, me personally, I'm not touching this at all right now. Just looking at the chart, looking at the max available for this chart. I see it hit a high back in 2004, and then it dropped. Then it came all the way down to like 17. Then it went back up a little bit in 2007, dropped again. And then it went all the way back up in 2018, then dropped, and now it's at 128. So me personally, unless I honestly looked at fundamentals on why overstock from from March at $2 to now at $128, I'm staying away from it. Because if you look at the history of it, it hits a high, and then after that high, within then it came all the way back. So within that same year, it loses everything that it gained. So this is just one of those where you would literally have to know the company, because you can get burnt on this one. Sector 180. Somebody got a question? I think that was all of them after overstock. Oh, hold on. No. Let's see. Three, yeah. Let's go to max. Okay. Looks good. Came back in March. So running. What is this? August. So it's over the 20, over the 200 by a lot. Still over it, and it's at the top of the Bollinger Band. 180. Still over it. 20. It's at it, but over the 200. I'll try to wait for it to go under at least go under the 20-day. Before I was to get into it. I mean, you could take this as that was just post-market, that it did that, and then hope that during pre-market it falls, or this could be the breakout that you needed for it to actually go for a little run. Because I know a lot of people, they'll wait for it to cross over your moving average, and that's when you'll get in for a little run, especially on options. And then you would buy when it falls under your moving average. So with it just now falling under, and it was just one hour, could be a little play. But I would see what happens pre-market, and then XLE. This is probably another one. Yeah. You're going to have to do your fundamentals on this one. I can pull up ETF database to see what's in it real quick. Yeah, just like, honestly, me looking at the chart, I know why you put this in there, because of because Mark said or talked about the contract for this, a long-term contract. But just looking at the chart, I'd stay away. But this is where you would break down each company. So let me pull up something real quick, and then I'll reshare my screen. So new share ETF database. All right, so on here, this is ETF database. So XLE. And you can pull up whatever ETF you want and then see what holdings it has in it. And then this is how you would honestly dissect a ETF. You'll look at its top 15 holdings, and then you will start going in and looking them up. So that's Exxon. XOM. You're gonna have to look at their fundamentals and see what they're doing. You got Chevron. It's a little better, but it's down here. It could obviously go back up some, but look at their fundamentals. COP. It's at the bottom, and this could be a good thing. So let's look at XLE one more time. So it's at the bottom. Hit the bottom here, went up. Hit the bottom here in 2016, went up. It's at the bottom now, and then it could go back up. So, and that could be the play, you know? But in doing so, you need to look at all the holdings and then see what those companies are doing. And if those companies are going to go back up, because if they're not going to go back up, then there's no point. So yeah, Mark said it, and Mark is way more right, way more of the time than I am. And I love him to death, but this is where you still just don't take, I don't care if Mark is right 100% of the time. You take what he says and you say, all right, cool. This is my initial, this is pretty much my, hey, I'm good with this company. He signs off on this company. Now let me do my due diligence on my own to figure out if this company is good for me. Because everybody's strategy is different. Everybody's money is different. So he could buy something and be able to hold it for a lot longer, or he can accept way more risk than a lot of other people can. Exactly. So yeah, so take that, be cool with it, be happy with it, but then at the same time, do your own research with that. I think at the XLE, that was everything. So stop the share. So that's all I got. I know Sean is back, but I don't know what he has. But if y'all don't have any more questions, Sean, did you need to say anything, or are you good? All right, I'm gonna say that he's good. So I'm going to stop.